YouTube, Salivate Metal here with some interesting thoughts from Kitco and their commentary here on the precious metal markets. And as usual, with a lot of these predictions, it's very tough to really pin down, but because there's so many different factors that come into play. And here we're talking specifically about the volatility index and its potential shift that could affect precious metals prices. We are seeing gold and silver take a little bit of a dip dip here lately. But this article is quite interesting. We'll kind of go through it here and see what you think about it. But the the volatility index was trading at 10.21, which is the lowest since January 2017. The low risk environment is weighing on gold, with prices hovering at a 3-week low, and last trading at 12.55.20 an ounce. So very interesting indeed. And here is a graph of that index here, and we see that the volatility index is very low, and the price of gold is being pulled down by that volatility index. It's quite interesting because right here during the financial crisis, we can see how the index spiked way up to 60 here. And that's after the low in 2017, and after that portion here, we saw the precious metals go way up here, and so very, very interesting indeed, and how that kind of correlates together. We can see here around 2005, they were both running very, very close together here, and then again we are running at that low, but what's going to happen from here on out? It's going to be interesting to see. The analyst added that because of the current market sentiment, gold could continue to suffer in the near term, but when investor fears start to pick up, the yellow metal will see renewed demand, which could push prices above recent highs. Well, that's an obvious statement for sure. The volatility in the markets and the like, playing on the fears of the investors, which could happen here. So here's a quote from Ronald Peter Stolferl. Because market complacency is so high, a reversal in the volatility index will be brutal. The fund manager and author of In Gold We Trust report, as soon as markets realize that the U.S. economy isn't actually in great shape, volatility will pick up, and that will be good for gold. He added that the indicators his firm monitor points to a growing stagflation in the U.S., lower growth with higher inflation, falling auto sales in the U.S., which on Tuesday showed the fourth consecutive months of decline. The first quarter economic growth of only 0.7% should be major concern for investors, and I certainly agree with that. We are starting to see a lot of these stagflation, and of course, there's a lot of sentiments that there's trouble ahead. And, and think about it, none of Trump's economic policies have taken effect yet. And I do think that if everything that he wants and everything that conservatives want, let's say the Freedom Caucus in the House, if we do everything that they want and get tax cuts and less regulation by congressional law, I think that it will have some effect. But nowadays, there's things about tax cuts and being uncertain, because it's not just the U.S. economy, it's economies around the world too. And businesses will hold on to those savings and hoard that money, as they have been doing really for since the Great Recession of 2007-2008, but even more so, because it's not a matter of growing your business, it's about saving your business. So I think that it won't have as much as an effect as it could have had these policies been put in place 10 years ago or 5 years ago even. So very interesting. And the gold prices have fallen a little. We haven't seen a significant shift in sentiment. Net speculative interest is at a 6-month high, as investors see value in holding a core position in gold as an insurance policy, as equity valuations remain overextended. Gold added despite the recent pullback in gold. there's still a degree of underlying support as investors grow concerned of a major market shifting event. And I think that's just it. 10, 12 years ago, that major market shifting event is very different than it is today. I think that it wouldn't take much today, whereas 10, 12 years ago, if something were to happen, it would have a nominal effect on the markets, whereas today it'll have a much greater effect. I mean, even looking back at 9/11, horrible atrocity that closed down Wall Street, literally closed down trading on Wall Street, had an effect on the markets, but they rebounded relatively quickly. Today, I don't think it could. I think something half as substantial would probably have a devastating effect on the markets. In my opinion, the entire world economy is more fragile today than it was 5 years ago, or even 3 years ago. And I think it's by and large because of the whole kick that can down the road philosophy. We can't seem to get rid of that notion, at least here in the United States, in our legislature. We can't seem to get rid of the notion that kicking the can down the road just will not do it anymore. We've got to tackle this debt. We've got to do things to really stimulate the economy to keep it growing. So, as this article basically outlines and suggests, there will be higher gold prices coming this year, probably. And again, this is an important part of the article. The indicators we are watching are highlighting a growing risk of a recession as early as late 2017. So look out for that, and I think that very well could be right. I think either way, whether or not there's an actual recession or not, I think that this volatility index is going to change. And I think that we will see some spikes coming in, and some significant spikes, and we will see gold climb up by the end of the year. So post your thoughts below. I'd like to extend the multitude of gratitude to y'all for watching, and encourage you to please rate, comment, and subscribe.